remember I left off in this class. All right, so entity level controls, right? So we did talk about control activities, right? And so so entity level controls are a part of what we would call control activities. But entity level controls represent the controls that are pervasive, right? So if those controls are absent, they have a pervasive impact on the applications and the controls in general. So for example, if management, an entity level control you would expect would be that there's a good oversight, that management has procedures in place to ensure that controls are being adhered to. So you wouldn't look for management to override controls. So if management overrides controls, that is an ineffective control that impacts it at the entity level, right? Because if management's overriding controls, then all applications, they can override any application control. Right? And so then that would render controls ineffective. So for entity level controls, they're really important that auditors identify what those controls are and identify that those controls are operating effectively. So in terms of entity, as I said, it has a more pervasive effect on the financial statements. So when entity level controls are not operating effectively or designed effectively, it could lead to a material weakness in the financial statement. And so the standard breaks it down into indirect controls, direct entity level controls, and direct entity level controls that do not precisely address the material misstatement. So for the last two, what precisely impacts or address risk material misstatement or does not is really going to be based on auditor judgment as they evaluate the internal controls. So we should take a look at a couple of them. Right. So here are some common entity level controls that you would expect to see in a company's control environment. So controls that relate to the control environment, right? So how management communicates the importance of internal control. There are procedures in place or controls in place to ensure that controls cannot be overridden. That there's effective oversight, for example, by management. Those would be controls related to the control environment. The tone at the top, like what is the tone of the company set regarding internal controls? Controls over management override would be an example of an entity level control, a direct entity level control that is precise enough to address the risk of material misstatement. So that would be an example of something that's direct, because as the example that I gave, that if they're not controls over management override, and management has the ability to override the controls that are in place, right? So let's say they have the ability to override segregation, controls set up to establish segregation of duty, then that renders the control environment in that area ineffective. So that would be an example of a direct entity level control that impacts the risk of material misstatement, directly impacts. Other things would be centralized processing and controls, including in shared services center. And shared services centers are just basically service centers where it's housed in one place, right? So it's like an area. So we had a shared services center when I worked in Bristol, where we did IT operated out of the shared service center, purchasing operated out of the shared service center, and it was purchasing for the entire organization. Right? So they called it shared because it was centralized, basically. That's what's meant by a shared service center. Controls to monitor the results of operations. Those controls would be more indirect. Not indirect, direct, that doesn't have a precise impact on the risk of material misstatement. controls to monitor other controls, including the activities of the internal audit function. The audit committee, again, they're indirect controls, right? Because those are after the fact in a way, right? If internal auditors monitoring it, if there's a problem, it's after the fact. They're going to detect it because they're monitoring it. It doesn't prevent a control it doesn't prevent any issues. Controls over the period and financial reporting process, policies that address significant business control and risk management practices. Those again will be more indirect entity level controls. Code of conduct, the whistleblower hotline, all examples of indirect entity level controls. So these aren't all inclusive, but just some examples. And I would say that what's most important with entity level controls, one of the key things that auditors are going to look for with entity level controls will be controls related to the control environment, and controls over management override in the company's risk assessment process, right? Because if the company doesn't have a good risk assessment process in place, remember, the objective of the risk assessment process is that they identify what could go wrong in their various applications and business processes, and then design controls to address that risk. So if they don't do a good job at the risk assessment process, then they're not going to design the internal controls to meet their risk. They're not going to appropriately identify the risk. Talk about testing of internal controls. So what we're concerned with when we're testing internal controls, what the auditor is going to look at is the design of the control and the operation of the control. So the design of the control is designed so that it would prevent or detect material mistakes, right? That's the objective of internal controls over financial reporting, is to prevent or detect on a timely basis errors or fraud. Whereas operating effectiveness is the control does prevent. And so you can design it. It can be designed to do that, but it's not operating effectively. It might not operate effectively because the person who's responsible for carrying out that control is inequipped to do so. They don't have the skill set to do it. So it's not that the design of the control is bad, it's the operation of the control that's problematic. So an auditor is going to, when they test internal controls, they're going to look at both the design effectiveness of the control as well as the operating effectiveness of that control. So remember, an auditor, at this point, when the auditor is testing the control, they've already made an assessment about the effectiveness of internal controls, right? And during the risk assessment process, right? When they're assessing the risk of material mistake, they've already made that assessment. So now they've said, okay, we have these controls, we think controls are effective, so we're going to rely on controls, so we're going to test the controls, right? Remember the way that auditors gather evidence, major timing and extent, is test the controls and substantive tests. And the substantive tests would be test the transactions, test of account balances, and substantive analytical procedures. That's how they gather evidence. So they're going to test controls, and their objective is to determine whether or not that control is designed and operating effectively. That it meets the company's objective, which is to prevent or detect a material mistake on a timely basis. So a deficiency, right, if that control is not working, or if there's a problem, that's what we call a deficiency, is it does, if the control is missing, that has been designed to address the risk of material misstatement, then it's a deficient control. So for example, if the company had a control, I use a three-way match as an example, right? The three-way match, before they will report, issue a disbursement or make a payment, they have to have three pieces of evidence that it's a valid disbursement, right? Purchase order, receiving report, and vendor invoice. If the auditor selects a sample of disbursements, and in their sample, they identify several instances where that those three documents were missing, the auditor would consider that a control deficiency because the control is missing. And then if an existing control is not properly designed so that it's operating effectively, but it's not a well-designed control. So meaning that the control is not effective to be able, or designed to be able to detect a material mistake or prevent it. So, some examples of what the auditor's process would be. So as I said, the client in coming up with their controls also has to go through this process of what could go wrong. That is the client's process for developing controls, right, or designing controls to address that risk. The auditor is also going to think about or ask that question, what could go wrong? And what kind of control activity should exist to address that risk? And then how are we going to test that control activity? So if we're talking about sales, sales revenue is reported when goods had not been shipped to the customer. What assertion is that? Sales recorded with goods not shipped. Why? Why do you think it's complete? What tells you, what makes you think it's complete?
Because the transaction hasn't gone through yet.
And then what does that mean? If you didn't ship it, right? Because that's what that means, right? Goods have not been shipped. Then you can't recognize revenue, right? So if you can't recognize revenue, that means that it's not valid. If you reported revenue and you don't have a basis to report the revenue, then the revenue's not valid, right? It's occurrence. It's occurrence, right? Because what is that telling you? Sales recorded for goods not shipped. If the goods didn't ship, then you don't have a sale. It didn't happen. So the control activity should be all sales invoices are matched to shipping documents before recording them. Before recording the sale, there is a shipping document. That's the control.
So if revenue was like understated, maybe because like for tax purposes and stuff, then that would be complete, right? Because you're not putting sales in there.
Correct. So the auditor would, and that's the third one. But the test of the control activity, right? That's the control. The client, that's the control activity. The auditor, the client would say, "Oh, we do X, Y, and Z. We match shipping documents and sales invoices before we report." The auditor would check the box and say, "Oh, that's an effective control," because that would prevent revenue being reported when it's not earned. The auditor would select a sample of sales revenue entries made in the general ledger, compare the time date stamp of the sales revenue to the time date stamp of the shipping document. So they're testing that control. Goods will be shipped to a new customer who is unable to pay for the goods. What is that assertion?
Existing? Do these new customers, do they really exist?
Well, that's not what that's saying. It's saying that goods are shipped to a new customer. And Valuation. What happens if you ship goods to a customer that's not creditworthy? That they're unable to pay, right? You're going to end up with bad debt. Right? So you're trying to avoid that. So management is basically saying, right, that so management's assertion is that, we are, for customers that we have done business with, they're able to pay, right? Because we have this control in place. The credit department performs a detailed credit check for all new customers. So that control would prevent, right, or at least detect, but it should actually prevent, goods being shipped to a customer that's unable to pay, because you would only add or ship to credit-worthy customers. Right? So if you're doing a credit check, right, then you're adding and you're following what the company's guidelines are, then you're only adding customers who are credit-worthy. So the auditor would, for example, with customers, examine documentation that indicates a proper credit check was performed. And then the last one, goods will be shipped to a customer and the revenue is not reported. What was that, Shannon?
That.
Okay. Hold on a moment.
She was building up to it.
Too
The
bad.
big reveal. Completeness, right. What's the difference between that and the first one? Understatement versus overstatement, right? If the goods shipped, then what you're saying, if you start with shipping documents, right? The goods shipped, that says that it should be recorded. It's a valid, revenue has been earned. So we should see it in the sales journal. And if it's not in the sales journal, then it's not complete. That's understatement. So again, all shipping documents are matched to sales invoices that have been reported in the general ledger. So that's the control. The auditor would select a sample of shipping documents and then ensure that the amount, compare the amount shipped on the date to the sales invoice reported in the general ledger report. Make sense? So again, the auditor's procedure is meant, right, to get evidence about the assertions that clients are making. Let's talk about, so, yes, did someone have a question?
No, we said bless you. No, we said bless you.
Oh,
Yeah.
oh, you see, I was like, I didn't see. Let's switch. So, the objective, so remember, testing internal controls, reporting on the internal controls, only required for publicly held companies. Whether auditors have the discretion or privately held companies to do it, but it's required for publicly held companies. And the objective of doing that, right, is after Sarbanes-Oxley required it, because after the Enron and WorldCom and all that other good stuff, they said that, look, you need to understand how these transactions are being generated, right? How it's being generated, that you can rely on the information that's being produced by the system, right? That the client has effective controls in place. And so they require auditors to report on the effectiveness of internal controls and then address that. So in order to do that, auditors would have to audit internal controls. Like they have to audit gather evidence about the effectiveness of internal controls. So in deciding what type of audit report, so in deciding what type of audit report, the auditor has to look at, well, do we have deficiencies? And remember, deficiency is that control doesn't meet the objective of preventing or detecting on a timely basis material mistakes. So it's not designed properly or it's not operating properly. And then, so that's a deficiency. Then the auditor has to decide, is that deficiency significant? And at that significant level, does it rise to a material weakness in internal controls? And a material weakness results in a adverse audit opinion on internal controls. So the things that auditors consider in terms of deficiencies and whether they rise to a level of significant or that material is to gather the information about the deficiency. Right? So what is this deficiency? Is it something like hugely big, pervasive, the deficiency results in a pervasive deficiency in internal controls, such as overriding, management override of controls? What's the nature of the control that failed? Is it as I'm saying, is it a management override? What about the frequency of the deviations in control in relation to the number of times the control operates? The design or operating effectiveness of the control. What is the risk material statement and the assertion associated with that control that failed? Is it significant risk or is it fraud risk? What's the size of the account or the disclosure or total transactions to the deficient control relative to the volume of the activity of the account balance or class of transaction? Are there any actual misstatements? So did the auditor uncover a material misstatement? And so the distinction I want to make clear before we go forward is the risk of material misstatement. That's a financial statement impact. A material weakness is an internal control deficiency as a result of an internal control deficiency. A material weakness does not mean that a material misstatement occurred. So, I'll show an example in a moment. So those are things. So auditors have to consider: is there an actual misstatement? Because an actual misstatement, if the objective of internal controls is that it prevents or detects a material misstatement on a timely basis, the fact that the auditors finds a material misstatement would suggest that there's a breakdown in internal controls. There's some deficiency in internal controls. Right? What's the period that it exists? What actions are management taking? Is management taking to remediate the deficiency? And does the deficiency relate to an indicator of a material weakness? So those are some of the things that facts that the auditor considers as they're evaluating. So a control deficiency we already defined, right? It's either not designed properly or it's not operating as designed. Right? And that would be considered a control deficiency. Then the auditor has to evaluate that for a significant deficiency. And a significant deficiency is defined as more than a remote likelihood that one or more control deficiencies will result in a material misstatement that will not be prevented or detected on a timely basis. And that's the auditor's judgment. So that's what you have to think about, because when we say remote likelihood, right, that's judgment. And so it's not as easily identifiable. It's somewhat subjective. Should be. Then we have a material weakness, and a material weakness is what results in an adverse opinion on the report on internal control. And so a material weakness is defined as a deficiency or a combination of deficiencies that results in a reasonable possibility that a material misstatement will not be prevented or detected on a timely basis. And again, reasonable possibility suggests that there's judgment involved. It's the auditor's judgment, how they evaluate the impact of this control deficiency. All those things that I talked about in the previous chart, right? How they examine or how they conclude on the factors that gave rise to this material weakness. Some indicators that would suggest that there is a material weakness But if there's a restatement of a previously issued financial statement, right? A restatement means a company has to, restate they've already filed their financial statements. There's an error that's been detected, or it's a statement that's been detected. Now they have to reissue, right? So that's a restatement of the financial statements. So again, if you had to restate your financial statements, that is only going to be if it's material. So there's a material misstatement somewhere, which would suggest that there was a control deficiency. So, in a material control deficiency, because it was absent in that control, those material misstatement. Evidence of material misstatements that the auditor catches. Again, because if there's a material misstatement, it obviously the controls did not prevent it. Ineffective oversight of reporting process by the client's audit committee. It's also, remember, we're talking about internal controls of the financial reporting, so that's the preview of, that's the responsibility, oversight of the audit committee, an indication of fraud, either material or immaterial, by senior management. So it's not just that with fraud, is, as I said, when we're talking about those things immaterial fraud. The auditor has indications of fraud by senior management that becomes significant. So the difference between a significant deficiency and a material weakness has to do with the likelihood of it occurring, not preventing, and the materiality. That a potential or actual misstatement would not be detected on a time, prevented or detected on a time basis. Yes?
What would be the difference between a remote and a non-remote deficiency?
Non-remote. I'm not
Yeah, so I guess like more like pervasive of the entire.
Oh, something that's pervasive?
Yeah.
Management override. So let's take, actually, let's for a second. Let's take a look at a report on internal controls, because it's Exhibit 5B, Chapter 5. It's in the appendix, actually. So on page 223, in Chapter 5, Exhibit 5B2. So remember, the auditor has to issue a report on internal controls, the effectiveness of internal controls. And this report can could be an integrated report with their financial statements, or it could be two separate reports. One for the financial statements and one for the report of internal controls. But if you notice, and we'll cover the reports more detail when we talk about audit reports, but I want to highlight here. Here's an example of what an auditor would consider a material weakness. So in this case, they define material weaknesses. It's the explanatory paragraph. They define it as a deficiency or combination of what we just said here. Reasonable possibility that a material misstatement would not be prevented or detected on the basis. Then they go in to explain why they're giving, because this would be an adverse opinion, why they're giving the client what the material weakness is that they identify. So again, during the year, so it's only during the year, current year under audit, senior management was able to override internal controls over financial reporting. Right, that's a pervasive control or deficiency that has an impact overall. Right, so a pervasive impact on the financial statements. So management was able to override those controls. This material weakness resulted in accounting errors that were corrected prior to the issuance of the financial statements. Right? So even though they're getting an adverse opinion on the report on internal controls, they're not getting an adverse or qualified opinion on the report on financial statements, right? Because they corrected whatever accounting errors there were prior to the issuance of the report, the report on the financial statements, right? So the financial statements in the auditor's judgment is not, are not materially misstated. So that would be an example of something that's pervasive that would lead to a material weakness. So the types of reports that they will issue: an unqualified opinion. Unqualified opinion is everything's wonderful. You know that the controls are effective to detect or prevent or detect a material misstatement. A disclaimer of an opinion is that we can't give an opinion. We were hired, to do this, but we can't. So therefore, we can't give an opinion. For whatever reason, they couldn't evaluate internal controls, so they can't say it's effective or not. They couldn't audit internal controls, and then an adverse opinion is what we just saw, right? That the controls are not effective to prevent or detect. It was a material weakness, and so that results in an adverse opinion.